Did I miss my window? That's a question I'm getting more than anything else these days. It's like maybe sellers who are thinking of listing now, they're worried they're past the peak, or it's buyers that they didn't buy a couple of years ago and they are still feeling like, is that my opportunity? I have a friend who has been shopping for a second home in Bend, Oregon for years. And he waited and he shopped and he looked, but it wasn't until this spring when the market was really going nuts that he started to worry, did I miss my window? Maybe I should buy now. He didn't buy now. So now he's waited. Now he's looking, and inventory is climbing in Bend, Oregon. And now his fear is the market going to crash? Did I miss my window? So we inevitably, no matter who we are, no matter what stage in the market, we're always worried that we've somehow missed the window. We have this fear about the market timing. At Altos, we just moved our offices from Silicon Valley to downtown San Francisco. This is an office that we're now in that you couldn't even get 18 months ago. And it was so crowded and price didn't matter. Now I wonder, did we do it too soon? Is it too early? Should I have waited? So today we're going to talk about the data and what the data says on that, and knowing that our clients and home buyers and sellers have this fear. So I'm going to try to frame the data around how we might talk about and knowing that people always have this fear, so that we can help them make better decisions, feel confident in the decisions, take action right now. So that's what we're going to focus on today. We're going to ask that question, did I miss my window? We'll also, of course, spend a lot of time with the detail of what the market's doing right now, what the leading indicators are saying is going to happen, and what's we can already see that is changing in this crazy market, but also what's not changing. We can see what's going to be more of the same for 2022. And then we'll wrap up with the local market looks like we usually do. A bit of housekeeping. As I'm talking today, there are two people from the Altos team on this session. They'll be in the chat, Jeff and Lael. So they can help answer questions on the fly. If you've got questions about something I'm referring to or about how you can get the data, they will be in the chat. Also, if I refer to something that has a download link, look in the chat, you can click through and download or connect that way, so you don't have to type those things in. As always, we make these slides available to everyone who's on the call. So if you will get the follow-up of this video and the slides later on, so you can go refer to it, and you don't have to take notes super frantically. But do drop the questions in there so we can, the reason we do these live is so we can have the conversation happening and capture what we are, what's going on right now. Before I dive into the data, as always, I want you to be aware of the eBook, the How to Use Market Data in Your Real Estate Business. This book is great for realtors, brokers, professionals in the space. Those of us who are having that conversation, like when a friend or a colleague says, did I miss my window? The ebook allows us to, it gives us scripts, it gives us time to use which data, how to frame it, how to understand what the data is telling us. It's really powerful. If you haven't already downloaded that book, go click on that link. It's in the chat and download it so that you can use data in your business. All right, let's dive into some data, shall we? Let's start with prices this week. The median home price in the US, single family home is $389,000. That's the dark red line here. You can see the multi-year curves where things peak and how it typically backs off in the second half of the year. The thing to pay attention to here, to know here, is last year at this time, the end of the year prices stayed much more elevated than than they normally would. In other words, prices typically peak June 30th. That's because the best inventory hits the market in April, May, June. They start getting absorbed going into contract in the second half of the summer. And then new listings that come on typically are slightly lower priced. And then by the fall, November, the prices then, like things that get sold over the holidays, have to be priced a little bit lower to make sure they move and they don't sit around on the market. So we get this yearly seasonal pattern. Last year, the demand stayed super elevated all the way through the holidays. And you can see prices didn't back off at all until late November, and then a little correction around Thanksgiving and Christmas before the crazy spring took off. We're at 10% price increases year over year. I'm going to show you some details about what that means in a sec. The light colored line here is the price of the newly listed properties. In the Altos data, I'm just checking, make sure we've got, okay, I'm just checking the chat, make sure audio is good. Okay, it looks like audio is good. Trying to make sure everybody's in board. Okay, so the light colored line here is the price of the new listings. And in the Altos data, we have a bunch of things that are leading indicators for the future of transaction prices. And this is one of them. What happens is when the new homes get listed, the sellers and the listing agents know exactly what the market is telling them. They know how many homes, how many overbidders were on the property down the street. They know how many people are in the open home. They know how many active shoppers they have. And they use that information to price the new listings. So when demand is strong, the new listings get priced strong. And you can see each year the new listings price peaks May 30th. It peaks a month before the market as a whole, and then backs off each year as we want to move things towards the end of the year. Last year, you can see the new listings stayed elevated all the way late until November. There was barely any back off at all. And so what that told us was that the transaction prices that were going to happen in December, January, like we could see the demand already in the data. This year, we've had a little bit of back off, much more normal seasonal, but not a lot. And that tells us that prices are going to stay elevated into the end of the year. We know that the demand is there. We can see it across all of the markets. And so this leading indicator is very strong for us. A little bit more seasonal than last year. Last year was the big anomaly, and now we can see, but still a super strong year of pricing to come. When we look at the annual gains, one of the important things to know about the data, about real estate data in general, and about where the Altos research data is coming from, is that when we see the headline, when we hear the headlines of the traditional data, they're several months, they're using data that's several months old before it gets to the headlines. For example, last week, the Case-Shiller Index released data for June. And the headline last week was that the June home prices had record price gains of 18% in the Case-Shiller Index. If you follow the Altos data, you would have seen that 18% gain that we could see in our active data in May. So 5 months later, the headlines are now showing what we could see in May. So this is each line here is a year, and it's tracking the year over year price increases. So how much does home prices in general across the country climbing each year? How much are values climbing? You can see last year, the light line had this little dip for a month in April and a couple of weeks into May at the start of the pandemic. Then what we realized was rates were super low, demand was super high, and by the end of the year, we finished 2020 with an 11% home price gain. This year, you can see, in the last few years, it's been a strong market. The home prices are in this 5 to 10% annual gain. This year, this dark line peaked in May at this crazy record high and has been backing off. It's been backing up because the comparisons to last year was super strong. So we're not going to have another 20% on top of the big year. But what we can see is that the headlines are 5 months old, and we can see it in the data there. We're at 10%. We're going to likely finish out the year at about a 10% price gain. And you can see that it's going to go sort of sideways from here. The end of last year was super strong in pricing. So the annual is actually the annual gains are harder to see. The important thing to know here is that when you're talking to clients, home buyers, home sellers, their opinions are going to be formed by the headlines, the general data, and those are always going to be 3, 4, 5 months late behind the actual data. So they're just now hearing record home prices that we could see in the data several months ago. So when you take your data, you take your Altos data to your clients, the important thing is to say, this is what's happening now, and we're looking at what's happening in the future. So did I miss my window? What we want to do is say, let's not worry about 5 months ago. Let's worry about what the data is telling us for right now and for the coming months. Let's switch to supply. There are currently 437,000 single-family homes on the market in the U.S. that actually climbed 1.5% this week up from 431 last week. The low point of the year was April 30th. Normally, the low point of the year is January 1st. It bounces around. Maybe it's in February that we have the lowest. And then by mid-February, inventory starts climbing. And it's a very normal cycle. Last year was, of course, the craziness. And this year, the whole market was shifted a good month or more later. So we didn't even bottom until April 30th. And then we started getting some inventory climbing. The indications are that inventory has peaked for the year. It's a holiday week this week, so the ratings that we get on Monday that we announce on Monday will have a dip, likely have a dip in it. Each Labor Day week has a market dip. And then there's not a ton more that comes to market in September, October, November. So it'll start trailing off. So we're really at a peak for the year. This is kind of interesting because at the end of July, I was expecting a more normal peak where we normally have our peak at the end of July. And so I was expecting us to peak at 400,000, and then we promptly blew right through 400,000. So as of right now, it looks like we're at our 440 or so peak. Maybe we get a little bit more at the end of September, but really this is what we're looking at. But what that means is really from here on out, until there are significant changes in the market, we're going to be in a inventory crisis, a restricted seller's opportunity market for the next several years. There's one thing that we've been talking about all year that is a caveat to watch this month. There is the biggest chunk of mortgages, homeowners that have been in the forbearance process are now exiting forbearance in September. You can see it's 400,000 total homes that are exiting forbearance in September. That's up from 100 or 200,000 a month for the last several months. And so what we've seen so far in the forbearance process is that almost none of these homes are being sold as distressed, as homeowners who can't modify their loan and get back into the process. Every once in a while, a tiny fraction, 1%, maybe, are coming to market saying, I'm never going to be able to make this loan. And therefore I got to sell now, the distress sale. There are no foreclosures because, as you see, we've had multiple years of extreme price gains and huge huge buyer demand. So if you are in a situation where you haven't paid your mortgage for 14 months, it's time to get out of the forbearance process, and you're never going to be able to make that mortgage payment again, you can sell and take your equity. So there's no foreclosures coming, but there may be a tiny little bit of inventory coming. So I have a quick poll that I'm interested in. I'm interested in, have you spoken with any homeowners that are in forbearance and that they are planning their exit? I'm interested in how many we know. And this is what I'm interested in gauging here is like how are they seeing them come out of the market? All right, I'll let a few more folks vote here. The vast majority of us don't actually know anybody in that forbearance process, but there are a few here. So this is going to be really interesting to see what the results are. Give a few more minutes. So have you spoken with any homeowners that are in forbearance and planning the exit? I'll give it one more second. Anybody else want to vote? All right, let's publish this. Vast majority, 80% of us, 81% of us don't know anyone in forbearance. But there are some who are in forbearance, they're exiting now, and they're selling. Like, that's really an interesting opportunity. It's not going to be, what it means is it's listing agent opportunities. There are people in September, October, November that will be finally getting out of that forbearance and capturing their equity. Almost none of them are negative equity. There's almost no short sales, but there are some who are interested in capturing that cash. So, and then there are some who are exiting and not selling. September's our month, folks. September's our month to capture that opportunity. And as we're marketing to those, remember that it is the message to those folks: demand is still there, supply is still tight, you have equity, let's get you ahead of this and get you that cash. Those are the opportunities in front of us. Really fascinating. So 14% actually have had some of those conversations. 20% of us have had those conversations in general. Some are selling, some are not, but most of us don't have the forbearance. By the way, the FHA loans are the vast majority of those in forbearance, and so, but they're in general, they're coming out of the forbearance process very well and very strong. If you are still waiting for a big wave of foreclosures, there's still a lot of American consumers who think that there is going to be some big wave of foreclosures, and we've been talking about this for a year now. There are none. There are no foreclosures, and likely as we wrap up forbearance, we're going to move very quickly into a record low, record few delinquent properties. We're going to move into, like, we have very few now, including those in forbearance, and we're going to move to record low very soon as this wraps up. And here's what it looks like when we're looking at years. So each curve here is a year. Inventory bottoms out in January, February, it peaks June 30th, and then, or July, and then it comes back down through the end of the year. So you can see the normal curve each year. You can see the green line here is where 2020 was so unusual, and we just adjusted to this new normal of inventory shortage. We're peaking right here, right now at about 440,000. There may be, if 1% of those forbearance properties come to market, maybe that goes to 445, maybe it goes to 450. But there are very few signals that are going to move it back to where we used to be. We would have normally have a million homes on the market right now, more than a million, but they would take some very big structural changes. So this is what we looked at for the year. We're likely going to end the year with fewer than we started the year with. And so we're now in a whole new inventory cycle. And until some big changes happen, we're going to be in this lower phase. That means seller opportunity, that means buyer competition, and like some of the realities we've had to deal with this year are likely around to stay. There are 5 factors that contribute to this, the reason that we're stuck in this lower inventory reality. The number one reason is that we have low rates. Low rates mean not just it's easier to buy, but it's more affordable to hold and not sell. So everyone in the country, essentially everyone in the country, has a mortgage of 3% or less. It's super cheap. So when I go to buy the next home, I can keep the first one for investment. And so I very much less likely to sell. Now I get 2 homes, I get an income property. And that's been happening over and over again. It's been happening for a decade. And each year we have fewer and fewer homes on the market. Then last year rates fell way low, and it happened dramatically. It results in what I call buy low, sell never. Everybody has a super low rate, super affordable payment, and therefore the opportunity is to never have to sell. When rates climb, let's say rates climb to 4%, what that's going to mean is that sellers are buying, the new payments are more expensive, and so I'm more likely to sell my old one so that I can make my new payments. So a little bit more inventory will come to market when rates climb. Then also demand backs off because it's more expensive. Each payment is less affordable. And so inventory builds up a little bit. Our estimation is that rates will have to be significantly higher for multiple years before we get inventory anywhere close to what it used to be. So rates are what can change here. We've been underbuilding for a decade. And so we have fewer new homes have been available, even as the population has grown, as the millennials, the biggest group of population ever is millennials, and they are now in their late 30s and 40s. They are in their peak home buying years. The demographics, that demographic change is not going to change until for 5 years, 10 years. Like there's a strong demographic tailwind. And then finally, all the policy, the laws are focused on homeowners. They were focused on keeping homeowners in their homes. They were focused on helping people make their mortgage payments. All of our policy is designed to keep homeowners in their homes, to help people own their homes. And as a result, we own our homes. That's not likely to change. So the biggest thing that is likely to can change in these 5 factors are the low rates. And so they will have to rise and rise consistently for a bunch of years before inventory can come out of this low space. So plan for low inventory and high competition through 2022 also. Let's look at demand. Let's switch gears to demand. In the Altos data, we have been tracking what we call immediate sales. This is a phenomenon. It's happened. We've been in a pretty hot real estate market for 5 years, 6 years now. And so it happens. You have Houses get listed, you get multiple offers, you take the offers and you sell in hours or just days after listing. And it's been happening for years, but it really kicked in this year in the first quarter. So as of right now, about 20 to 25% of the homes that get listed in a given week are going into immediate sales, taking offers essentially immediately. And what that means is they really bypass the active market data. They don't even spend a week in the active market. They're already gone. And so what we're interested in tracking is the dark here is the new listings that hit the market and stay on the market. And the lighter line here are the ones that hit the market and go into contract immediately. These are our immediate sales. You can see the activity peaks that first week of July and starts to tick down. What I've been looking for here, and I haven't yet seen, is the percentage of those that are immediate sales. Does that start backing off at all? Does it start to normalize a little bit? And it really hasn't. I kind of expected it to cool off a little bit this at the late summer, but it's still 24% of the active market. Like 24% of the new listings they're selling immediately. And you know this if you've listed a home anywhere for recently. The reasonably priced ones, there are definitely folks who are testing the waters and trying to price extra high to see what they can get. And those properties won't get immediate sales. It's a technique, but we can see these. So what I haven't yet seen, and if you're interested in this and using this as the leading indicator, gauging whether demand is or validating your own personal experience in your local market with the national market, is watch this each week. So our weekly videos, we're reporting on this each week, and we'll see if this starts to compress a little bit later October into November, the holidays, and see if we can watch it back off, or if it stays elevated, which then says, like last year, our first quarter is going to be a rocket ship again. So that's going to be a leading indicator for us to keep our eyes on. Here's one more way to look at this on the side. This is the new listings volume without those immediate sales. And so you can see normally we'd have these 100,000 home weeks. Last year, each line here is a week. And last year there was no peak of the market because they were all going immediate. And they were going immediate. And so then you have dramatically fewer homes new listed. You can see Thanksgiving and Christmas each year here. You can see Labor Day where we are right now. So there'll be a Labor Day dip this week. And the 4th of July dip. You can see each of these holiday dips in here. Last year we had a ton of immediate sales. And then the beginning of the year, we didn't have a normal building of inventory because they were selling immediately. But we are peaking a little bit higher than we did last year, so slightly fewer immediate sales. And so you can see that maybe 2022, we're gradually getting slightly fewer buyer competition. You know, the story is a colleague who runs a mortgage firm who is working with first-time home buyers. And so many of the first-time home buyers this year were just priced out of the market. They had to waive inspections. They didn't have all cash. So many of those buyers got priced out this year. And this fall, they are getting slightly more opportunity. There's slightly less competition from second home buyers, investment buyers. Those mortgages are more expensive. So those folks are getting, so the first-time buyers are getting slightly more opportunity. And it looks like 2022 will continue that trend, and we'll have slightly fewer immediate sales, slightly more on the market that gives us opportunity to do things like have an inspection contingency. Let's look at some more leading indicators. One of my favorite leading indicators in the Altos data is the percentage of homes on the market with price reductions. Normally, and this is our annual curve, so each line is a year here, you have The strongest part of the market happens in March and April and May. That's new inventory comes on. Buyers are buying for the summer. Then we get later in the year and more homes have to take a price cut. So normal range is like 30 to 35% of homes are on the market, have taken a cut before they sell. They're overpriced a little bit. Sometimes that overpricing is strategic. Sometimes it's accidental. Sometimes it's a crazy seller who wants to see what they can test. But whatever it is, about 30, 35%. You can see these, most years are in this normal curve. Last year, when the market took off, 35% of homes think they're overpriced, but all those multiple offers are happening, the overbids are happening, and only 25% had to take a price cut. That was when that market really kicked in. The dark line here is this year. And so the peak of our frenzy, 35% of homes think they're overpriced, but only 15% in April of this year had to take a cut. That was when the craziest, that's when those new first-time buyers, they're getting priced out. There's all cash offers. All of the craziness is going on because that's when the demand peaked. What we see here is this year is rapidly normalizing. We're now at 27% price reductions. It's not 35, right? It's not in this 30 to 35 range, which would be normal. So it's still hot, but it's not crazy. And you can see we're going to get right back into our normal cycle where 30, 35% are overpriced and they take a cut. That says demand is strong, but is not crazy. So last year at this time, we could say, aha, the next 6-8 months of demand is already baked into the market. We can already see that the extreme price gains coming. And so the leading indicators right now at 27% and normalizing. So that shows us we're going to have we have strong demand and good price appreciation, but not absurd price appreciation. That one's really strong to me. This one's actually encouraging to me because it means we're getting back into normalcy, normal strong market, but not crazy. And you know, this stuff earlier in the year was unsustainable and scary. So for when we're talking to buyers right now, or buyers and sellers right now is an interesting one with this price reductions. You can use your price reductions in your local market this way. Seller says, I hear record price gains. I saw the Case-Shiller last week for May, and it was, you know, we have record price gains. I want to try to list it. I'm going to see what kind of suckers I can get to buy my property. What you can show them is you say, look, we can overprice your property, but 27%, or in your market, maybe it's 30% of homes are taking price cuts right now. And that's because buyers know exactly where to price it. They know where to make offers. And if we're overpriced, you're going to sit on the market and you're not going to sell. So you can use price reductions as a powerful motivator, a strength for your sellers. You could also use it this way, which is we'll price it where you want to, but we're going to keep our eye on this number. If this is ticking up while we have your house listed, that's the market giving us a signal. So that's your price reductions number. Take a look in your local data at where your price reductions are. The leading indicator of the market action index is the other one that we like to use, especially when you have a home listed. And the phrase is this: while we have your house listed, I want you to look at one number. I want you to keep your eye on the market action index. I'm going to put your Altos report in your inbox every Monday, and I want you to look at one number. Right now, we are in strong sellers market. No surprise, we're in a strong sellers market. We are well off the peak of insanity and starting to come back to a more normal sellers market. We've been in sellers market opportunity for years because, remember, you know, rates have been low. We have been underbuilding, all of those things. So 59, so this is a scale, a 0 to 100 scale. 30 on this scale is balanced, buyers and sellers. So 59 means we're in strong sellers market territory. It's high. What's important here, this is supply versus demand. So it's not just a demand indicator, because supply could be high, and if the demand is kicking in really fast, like that's seller's opportunity. But if demand slows for the same level of supply, all of a sudden you get buyer opportunities hit. So on this scale, this is a scale that tells us is that when we're in this strong seller's market range, it tells us that the future pricing is going to continue to rise. We have tight enough inventory and strong enough demand that this is seller's opportunity. If this falls while we have your house listed, that's the market telling us that we're cooling right now. And so if it were to fall, say, close to 30, and there are some markets in the country who are starting to get more balanced. This is national numbers that we're looking at, but I'll show you some local ones. And so that's going to be buyer's opportunity, and that's going to tell us that we have opportunity, that it's the market cooling while we have your house listed. So for some folks who are, they don't want to, like, are afraid of the data, they don't understand all the data, like you can say, keep your eye on this one number. It works like a speedometer. When this thing goes up, that's the market climbing. When this falls, the market is cooling. 30 is balanced on this scale. We are, as we're wrapping up some of the leading indicators and the demand indicators here, looking at the days on market and the active market. We hit record low this year, is across all price points across the entire country. This time of year, the things start sitting around a little bit longer. We're past the beginning of the school year. So if you didn't sell in August, things start to sit around a little bit longer. We're still we're at record lows for this time of year. We're still far below what the best time is for more normal, even normal years. So, but ticking up, right? So again, it's an opportunity that says we can sell. We're likely to be able to price well and sell, but if you price too high, it's not. It'll sit. And we can also dive into the days on market in your local market and in your price range. And then one final leading indicator to watch. This is going to be important, especially if you or your client are still worried about you have a bearish view on the economy, on interest rates, on the American consumer. When the market starts to cool, what you see is you see homes that might get an offer, and then an offer falls through. There might be contingencies failing. There might be financing that can't happen. All of these things cause a property to go into contract and then get relisted. Usually it's about 1.5% of properties. It spikes at the holidays because if you didn't sell over Christmas, people take their home off, and then early January, you relist it and you try again. And so each year we have a spike in January. This year, very few needed relisting because demand was so good all the way through the holidays that our spike was much lower. But if buyers are getting cold feet, if they are afraid, if financing is getting hard, if they think they've overpaid, if the contingencies, if any of those things are happening, what you'll see is that 1.4% of relists all of a sudden starts to ratchet up to 2% or higher. And so this is going to be a leading indicator for a cooling market. What we see right now is that there is no sign of relists, of bearishness in the buyers. And so this can be very valuable, especially if you have like the clients who are like the vultures and like, I'm going to swoop in for the deal. You can say to them, keep your eye on the relist percent. If we see the relist percent climbing, that's opportunity for you, for your vulture, your cash buyer. Right now, there's none. So you can sit around and wait. You can wait. How long are you going to wait for that deal? But that's the one to keep our eye on. And so when I get feedback from the market bears out there, they are worried about the American consumer, and they're worried about that. And they're worried about foreclosures. One of the things I do is I keep my eye on the Relists and say, is there anybody in the country that's telling us that that's starting to come through? Okay, that's Realist percent. And then let's dive into the market price segments, and we're going to switch over to our local data, and then we'll wrap up. We've been talking about all our data at the national level for all price points. It's a pretty broad measure. This year, the market's been going, it's been strong everywhere. It's strong across geographies and across all price points. But you can really see how the price points change. So in every Altos report, we'll have these different price point ranges. Every market has a low, medium, high. The high end of the market may be behaving very differently from the low end. And so very often you might have a client who says, I see everything going in 28 days. And you say, yes, but you're listing at $1 million here, you're twice that. And if we overprice, it's going to take too long. So this is how we use the days on market in the price range. And I'll switch over, but I want to encourage you to, when you grab your Altos reports, to use those price ranges, because the high end of the market may be behaving differently from the low end, and it's always got some specific segment in, behavior in your client's segment. Okay. And then finally, I mentioned interest rates. When rates climb, it's not going to be until rates climb that we are going to have any opportunity for more inventory to come in. What we've got here is, so this is 10 years of mortgage rates. In the last 2.5, we've been just below 4, falling. We're still at 2.8%. Rates are not climbing. We expected them to climb in this a little bit earlier in the year, and then they didn't. Our long-term average has been 4%. It's actually ticking down to now 3.9. So the question is, so rates have to rise before the market cools, and inventory can climb. What we don't know is, we do know that when rates climbed in 2018 from 3.8% to 4.9%, in that time, we could see inventory build. We could see demand back off. We could see price reductions climb. We could see relists climb. All of those leading indicators that I've been sharing, you could see them kick in as rates climb there. What we don't know is, are we going above 4.9%, or is it just going above 3 that's going to cool the market right now? But because it's so low, until it changes, until it starts changing, we're going to be stuck in this tight inventory environment. Okay, I'm going to switch now to sharing the. Let's do this. Let me just share mine. Okay, let's do some local data. I've got a handful of local reports up. This is the Altos report, and what we're looking at here is this is San Francisco region. In what we can see, one of the reasons I had this up is the active market here, the market action index, is still strong sellers market, but you can see it ticking down last month to this month. You can see it backing off, and this is, it's the fall, it's a late summer fall, so it's normal, but it's still significantly high, but we can see the thermometer or the speedometer moving. The other place to point out in the San Francisco market here is down here in the days on market in the price range quartile. So anything under $1.5 million is moving still in a week or fewer. And you can actually see where the highest demand section in the Bay Area is right here at like $1.4 million. That's because the properties under $1 million are really tiny and really old, but But so you can actually see that the demand is higher here. And then of course, anything up 3 million and up takes significantly longer to sell. It's still 40 days, but using the price range, like the difference between having a buyer in this range and a buyer in this range is a significant competition, or a seller in that case. That's what I mean when I say let's use the market segments when talking to customers. I mentioned Bend, Oregon earlier. My friend has been shopping for a second home in Bend, Oregon for years. And so he was worried that he missed the opportunity of a few years ago. And then this spring, he was worried. And that when the inventory, normally there's maybe 800 homes in Bend. This spring, there was 180, 90 homes. And he said, oh, have I missed my window? Now inventory is starting to climb back up, and I've got the inventory chart selected here. Inventory is starting to climb back up, and now he's worried that he's like, oh, I see a lot coming on the market. Have I missed my window? Is it going to crash from here? But the context here is, we are so far below normal that this is not a crash scenario. But this is a little bit more opportunity for you in Bend, Oregon. You can also see price range, the $2 million homes in Bend versus anything under $1 million is moving quickly. I had a conversation this week about some of the climate crisis areas. Do people react when the hurricane hits or when the fires hit? And we've looked at this over the years. Again, and it's really fascinating, is that broadly, it's really hard to see the market impacted from any of the acute climate crises. So, for example, New Orleans, Hurricane Week, we can see that New Orleans is still in seller's market territory, but is much more close to balanced, but doesn't cratering. So I've got the inventory chart open here too, and where we might see a slightly fewer homes listed week to week, we don't see a crater. We see back off of transactions that happen for a few week schedule, and then back to pace is normal. We can see the price decreases in New Orleans at 41%. So New Orleans typically has a higher scale of price reductions than the case. So like the cycle of price reductions in New Orleans is in a 35 to 45% range. This year earlier, we're 35. And so we're now climbing back. We're still lower than normal. It's still a stronger market than normal. But significantly fewer, slower transactions than happens on that as a country as a whole. Truckee, California is the forest fire markets, and the question is are we seeing any impact there? So Truckee has cooled off on the market action index, getting closer to balance this year, but pricing staying normal. Here's our price decreases in Truckee. So price decreases in Truckee, 20%, sometimes 25%. It's been a hot market there for years. And then all of a sudden, last year, price reductions, 30% think they're overpriced, but only 10% have to take a cut because there's so many offers. This winter, 5%. It was so nuts. Things are still moving very quickly in Truckee. The price reductions don't need to happen because the demand's still there, even though the fires are, impacting. So the fires we see things normally based on buyer demand doesn't seem to be impacted by acute things like fire. And then the last one I pulled up was Duval County, Florida, or Jacksonville, Florida, which is the one where was up until the last couple of weeks was the hardest hit COVID market. So I was interested, does that slow down the real estate market? You can see in Duval County, Florida, we're ticking back just a little bit on the market action index, but still strong sellers market. We can see a little bit of inventory climb this year from ultra low, normally a third of what would be on the market. So a lot of inbound migration, a lot of demand, and very little, we can see very little impact necessarily, maybe a slight curve here on the inventory new listings that maybe cooled down from COVID in August. So it's fascinating to see very little impact of on homes of the acute things, the climate crisis or the pandemic stuff this year. People are making longer term decisions. Okay. This is normally where people ask, can we look at your local market? And the answer is yes, we can look at your local market. The easiest way to do that is to grab time with someone on our team, book a demo with us. We'll share a link in the chat. When you book a demo with us, we can look at your local market. We can talk about how you are building the data into your business, and really like how you communicate with clients, how we're converting new business, how we're helping people make those decisions when they're sitting there worried, like, have I missed my window? Like, this is what the data is telling us. This is how we can take our opportunity to take action now, to be more confident in our decisions, to be best informed. So that's all the time we have for today. There's a lot of stuff we covered. The video will be emailed to all attendees. So just keep your eye out for your email. Book time with our team if you want to see the local market, and also make sure you grab that eBook if you want to learn scripts, learn how to use the data in your business. All right, that's all the time we have for today. Thank you, everyone.